April 28, 1942. A trading floor. New York. The Dow Jones prints a number nobody in that room has ever seen in their lifetime. 9 seats on that exchange, once worth $600,000, are selling for $17,000. Dividend yields have climbed to 9.5%. Not because American corporations have suddenly become generous. Because nobody wants to own them. France is gone. Pearl Harbor is still a wound. Singapore has surrendered. German submarines are torpedoing American tankers close enough to shore that people on the beaches of New Jersey can see the fires. The smart money is out. The old money is out. The careful money is selling everything, not gradually, not strategically. Now, that man on the trading floor is staring at the same question many of you are asking today. As missiles arc across the Middle East, as the Strait of Hormuz tightens, as war grinds through its third year in Eastern Europe, what do you actually hold that survives? Before we go any further, nothing you're about to hear is financial advice. Fiscal historian examines the documented record. What you do with it is entirely your decision. We are students of the past here, not brokers. Act 1. The lie they sold you. The official wartime investing story is clean and simple. Buy bonds. Support your country. The government will protect your savings. 85 million Americans believed it. They purchased $185 billion in war bonds. The Series E bond sold at 75 cents on the dollar, promising it to 0.9% annual return over 10 years. The Treasury called it the greatest investment on earth. Hollywood stars sold them at rallies. Factory workers signed up through payroll deductions. Children collected quarters in stamp books at school. History tells a quieter, uglier story. A 2023 study by economist Brunette Hilton-Jermsky, published through the National Bureau of Economic Research, found that a Series E bond purchased in June of 1944 delivered a cumulative real return of -3%. For most redemption dates after 1946, the real loss ranged from 16 to 22%, to post-war inflation spikes 14% in 1947, nearly 8% in 1948, consumed the promised returns before the ink had dried. A factory worker who faithfully bought bonds through payroll deduction from 1943 to 1945 had less real purchasing power a decade later than the day he started buying. -13%. The political fallout was measurable. That same study found counties with higher war bond participation shifted disproportionately toward the Republican Party through the 1950s. The betrayal was quiet, but it was felt. Nobody called it a default, but inflation is a default. Just one that doesn't make headlines. Here is the mechanism. The Treasury never advertised. The Federal Reserve deliberately pegged interest rates at artificially suppressed levels from 1940 to through 1951. A policy economists call financial repression. Rising prices were used to shrink the real value of government debt. Bondholders paid for the war twice, once with their money, once with their purchasing power. The greatest investment on earth lost money, not through dishonesty, through inflation. Act 2. What actually worked? Equities back to that broker. April 28, 1942. If he bought the Dow at that moment of maximum despair and held through VJ Day, his total return exceeded 100%. The market's turning points tracked the battlefield's turning points with remarkable precision. After Midway in June of 1942, after El Alamein that October, after Stalingrad that winter, the Dow never looked back. Defense and industrial names led. Boeing built the B-17 and B-29. General Motors produced tanks and aircraft engines. Henry Kaiser, a mid-size contractor before the war, built nearly 1,500 cargo ships and 50 escort carriers. He died in 1967 controlling an industrial empire. Andrew Higgins went from 75 employees in 1938 to building the landing craft that delivered Allied soldiers onto every beach in the Pacific and at Normandy. Eisenhower said he was the man who won the war. But here is the uncomfortable question fiscal historian has to ask. That worked because America won. What happened to the people on the losing side? Act 3. The 14 to -1 rule. Germany. June 20, 1948. A 26-year-old American economist named Edward Tenenbaum executes one of the most consequential financial events of the 20th century from a set of barracks near Rothwessen Castle. Every German citizen receives 40 Deutschmarks. Then 20 more. Bank savings are converted at roughly 10 Reichsmarks to 1 Deutschmark, the effective rate settling at 6.5 new marks for every 100 old ones. a 93% loss overnight, but stockholders in real companies that made things, employed people, owned factories, fared dramatically differently. When the Allies broke up IG Farben into BASF, Bayer, and Hoechst under U.S. High Commissioner Law No. 35 in August of 1950, shareholders received stock in every successor company. For every 1,000 Reichsmarks of IG Farben stock, holders received approximately 915 Deutsche Marks in successor shares, an effective conversion rate of nearly 1-to-1. Compare that to the 6.5 to 100 rate for cash equity. Holders preserved 14 times more wealth than cash holders through the same national catastrophe, 14-to-1. The mechanism matters. The Reichsmark died because it was a government promise, and the government that made that promise no longer existed. But a factory still stood, a patent still worked, a customer still needed chemicals. IG Farben's chemistry did not care what currency was printed on the invoice. The productive asset survived because its value came from what it could do, not from what a government stamped on a piece of paper. Japan tells the same story with even sharper numbers. The yen, roughly 4 to the dollar in the early 1940s, was fixed at 360 to the dollar by 1949, a decline of over 99%. Consumer prices rose more than 360% in 1946 alone. The government froze bank deposits in February of that year, effectively confiscating liquid savings from every citizen in the country. The great Zaibatsu, Mitsui, Mitsubishi, Sumitomo, Yasuda were broken apart by American occupation authorities, but complete dissolution never happened. By 1948, Washington's priorities had shifted from punishing Japan to rebuilding it against Soviet communism. The former Zaibatsu reassembled as Keiretsu. Family control was permanently broken, but the factories, the shipping lines, the trading networks, they survived under new ownership structures. And the land survived. American firebombing destroyed -1 square miles of Tokyo in a single night. March 9, 1945. Between 80 and 100,000 people died in hours. But the land registration system endured. Property records survived. People who owned urban lots in Tokyo, even lots where nothing but ash remained, retained legal title to ground that would eventually become among the most valuable real estate on earth. Italy, the lira went from 19 to the dollar in 1927 to 625 by 1949, a 97% devaluation. Cash was annihilated, but the Agnelli family kept fiat intact through a layered holding company called IFIL, established years before the war. Johnny Agnelli served as an Axis officer on the Eastern Front, then pivoted to liaison with American troops after the 1943 armistice. At its peak, the family controlled assets equal to over 4% of Italy's entire economic output. The pattern repeats. Yugoslavia, 1994. Monthly inflation peaks at 313 million% in January. The dinar becomes wallpaper. But researcher James Lyon documented that Barrack, a common street pastry, remained stable at approximately 1 Deutschmark throughout the entire hyperinflation. Hard foreign currency maintained purchasing power while domestic currency became confetti. Different instrument. Identical mechanism. Act 4. Could it happen here? The honest answer is, it already has. Twice. Executive Order 6102, signed in 1933, seized private gold under the Trading with the Enemy Act of 1917, a wartime statute repurposed for peacetime. Americans were given less than a month to surrender coins and bullion at $20.67 per ounce. Roosevelt then revalued gold to $35, keeping the difference for the Treasury. Milton Friedman estimated only 1 in 4 Americans actually complied, but the legal precedent was permanent. Executive Order 9066, signed in 1942, forced 122,000 Japanese Americans from their homes with less than 2 weeks' notice. Properties were sold at fire sale prices. One 45-room hotel went for $2,500. Total property losses reached an estimated $1.3 billion in 1983 valuations. Congress did not formally apologize until 1988. The mechanisms of wealth transfer have evolved. Today, the Foreign Account Tax Compliance Act, FATCA, requires over 110 countries to report American-held accounts to the IRS. Many foreign banks now refuse American clients entirely. This functions as a capital control, wearing the costume of tax enforcement. You do not need a confiscation order when you can simply make it impossible to move money across borders. Act 5. The 4 strategies documented. History across every conflict studied, from the Civil War through the Second World War through Ukraine, points to 4 strategies that real people used with documented results. 1. Equity in productive enterprises. Held through the crisis, the Quandt family offered battery production services to British occupation authorities within weeks of German surrender. Herbert Quandt received an operating permit despite his wartime record. In 1959, he increased the family's stake in BMW to 50%, saving the company from a Daimler-Benz takeover. His heirs today own over 40% of BMW. Friedrich Flick, convicted at Nuremberg, sentenced to 7 years. Served 3, used the proceeds from remaining rare holdings to acquire devastated industrial concerns at fractions of true value. He took a 40% stake in Daimler-Benz and became West Germany's richest man by 1970. The pattern wasn't stock picking. It was owning a piece of something the post-war world still needed. 2. Physical gold held outside the banking system, on the black market in post-war Germany. Gold commanded enormous premiums over its frozen official price. American cigarettes traded as a parallel currency, but gold was the only asset that held value across borders, across currencies, and across occupations. The critical word is outside. Frederick Barbara Campbell stored 5,000 troy ounces at Chase National Bank. The government seized every ounce. The families who preserved wealth kept their gold where no institution could reach it. Today, physical gold stored in a private non-bank location uses the same mechanism. If its value depends on an institution honoring a promise, it is not outside the system. It is the system. 3. Geographic diversification, established before the crisis. Britain's Operation Fish, the largest physical transfer of wealth in history, moved approximately 1,500 tons of gold and securities worth over 200 billion in today's dollars from London to vaults in Ottawa and beneath Montreal's Sun Life building. Not a single ingot was lost. The families who preserved multi-generational wealth had already established structures before the first bomb fell. The modern version is harder. FATCA has made foreign accounts visible in ways they never were before. But self-custody Bitcoin exists in no jurisdiction. A memorized 12-word seed phrase carries unlimited value across any border, with zero physical weight. When Russia invaded Ukraine in February 2022, the central bank froze electronic transfers. Ads ran empty. One Ukrainian crossed the Polish border carrying nothing but a USB drive containing his life savings in Bitcoin, invisible to every checkpoint. That is the same mechanism as Operation Fish. The instrument changed. The principle did not. 4. Land, not as speculation, but as foundation. After the Civil War, Confederate currency reached 9,000% inflation. Every Confederate dollar was worthless at surrender. The largest wealth destruction was emancipation, which eliminated roughly half of aggregate Southern wealth overnight. Yet land survived. Research published in the American Economic Review found that while slaveholders lost 50 to 70% more wealth than comparable non-slaveholders by 1870, their grandsons had fully converged economically by 1940. The mechanism was not the land's price. It was the land's utility, as collateral, as income, as a platform for recovery. In Tokyo, lots that were literal ash in 1945 became the most valuable ground in Asia within a generation. Each strategy carries real limitations. Gold can be confiscated. It has been. Geographic diversification faces tightening surveillance. Cryptocurrency depends on functioning infrastructure. Land can be expropriated, as it was across the Soviet zone of Germany and Japan's countryside. No single asset is invincible. The families who survived were not the ones who found a perfect hiding place. They were the ones who never put everything in one. Closing here is the insight most financial history leaves out. Every war in recorded history was financed the same way. Not primarily through taxation. Not primarily through borrowing. Through inflation. The government expands the money supply. The currency dilutes. And the people who held that currency discover, always too late, that they were the ones who paid for the war all along. Bonds were not investments. They were instruments of transfer, moving purchasing power from ordinary citizens to the war machine, one payroll deduction at a time, and returning it years later in cheaper money. The question history actually answers is not which asset survives war. It is which assets sit outside the mechanism governments use to pay for one. Every asset that has worked or productive equity, physical gold, geographically diversified value, land, shares a single property. A government cannot inflate it away by running a printing press. That is not a coincidence. That is the lesson.